Right now, school is different. Work is different. Even happy hour is different. While we're all working together to make sure different works, it's good to know that some things remain the same. We're still here, keeping you informed, helping our community with retirement strategies, and offering you guidance. And even if your strategy needs to change, we'll help you keep your dreams for retirement the same.
Good afternoon, folks. Don Galade here from GFS Financial Advisors. I'd like to welcome everybody for the event that we're having here today via the virtual world of webinars. Things have changed a lot in the last 2 months, and some things may have changed for a very, very, very long time. So that being said, what we're doing today is to give you an educational webinar. The goal for this is not to sell you anything. The goal from this is not to try to get you to sign up and buy something. But after we're done, if you feel that what our firm offers and what our firm does has something of value to you, that you'd like to have some additional information, we welcome the opportunity to speak to you and maybe just chat a little bit about your individual case, your individual situation, and see if we might be able to improve upon what you have going on financially. So we're going to talk a little bit more about that in a minute. But first, let me just share with you, there's a lot of folks that we work with. Some are in-house in our office, some are not. The folks that are in-house in our office are, you'll speak to them if you do business with us on a regular basis. But we have some partnerships with some people that actually have some fame to them, if you will. They've been seen on various different talk shows, various different financial forums on Fox and Friends and Fox Business. And they're some of the people that we reach out to when we have questions about specific things for our clients. So it's pretty neat relationship that we have. Now, whether you watch CNN, Fox, Bloomberg, Barron's, it doesn't matter. The point is, where you get your information from is different for everybody. However, many times the information is conflicting. Many times it's two people saying the exact opposite about the exact same topic. So we can understand where the confusion is. We can understand when people say, should I do this? Should I do that? So here's the first thing that I need to caution you on. When you're watching a financial talk show, when you're watching something primarily where people have their goal is to sell books, for example, they have a tendency to give market advice for the masses. It's kind of like going into the doctor's office and he recommends everybody take the exact same pill. Well, obviously not everybody needs the exact same pill, so technically the doctor has to meet with everybody individually. The doctor has to sit down and figure out where it hurts, talk about your family history, do some triage to figure out what exactly it is that you need, if anything, to take. So that's what we consider good advice is, first of all, seeking somebody who's A, qualified, B, knowledgeable, 3, has experience in doing this for a very long time, but most importantly, takes time to get to know you, takes time to get to understand what it is you're trying to accomplish with your goals. They're not just saying, oh, let me see what you have, I think you should put it here. And sometimes that happens, but that's not how we do things. We have a very tailored approach that is specific to every person only. In the system is we meet, we discuss, we learn, we talk, then we present a possible solution to something that has come up through our conversation. Okay, that being said, I want to talk to you about what I call the map. Now, for the guys watching, we don't do maps, right? We don't get asked for directions. We thank God for cell phones and GPS and all that other cool stuff. But anyway, when you were younger and you're going on vacation, the first thing you did was have a map, and you would figure out the best way to go, the best route to take. And if you had the map, you knew how to get where you were going. So it's very important that you have the map. However, some people with finances, they don't have a map. So they're just kind of drifting along. And we're going to show you how exactly you would have a map and how you can create one. Now, talking about advice, I'm just going to make this screen larger for 1 second. There's basically different types of folks that you can speak to with regard to your advice. Now, you have a person who would be referred to as an insurance agent who sells commissions such as life insurance and annuities, and they work for a specific insurance carrier or a myriad of carriers. And then you have somebody who's referred to as a broker, dealer, or a registered representative. They sell a myriad of products as well. However, they're held to what they call the suitability standards, much like the insurance agent. The third type of entity is what's called a registered investment advisor, and the firm is the registered investment advisor, not the person. So GFS Financial Advisors is a registered investment advisor, which basically says that we normally work on what's called a fee-based system, and we work on behalf of the client as what's called a fiduciary, which pretty much means we have to put your interests above our own. And there's a lot of disclosures involved, which I can invite you all to go to our website and check out, GFS Financial Advisors. And you can check down on the bottom for the disclosures. You could read all of that data. But it's important to know who you are dealing with. It's important to know how they are licensed. It's important to know how they are paid. And these are great questions that you should ask any financial advisor that you're doing business with. You should say, listen, what products are you going to offer me? Because if you're dealing with somebody that's only selling insurance products, as long as you're okay with that, just be known that that's what they're offering. And if you're dealing with somebody who's only selling stocks, bonds, and mutual funds, and they're not selling any insurance-based products, if you're okay with that, fine. But generally, a registered investment advisor works with a myriad of different companies, such as Fidelity, TD Ameritrade, American Equity, Allianz, etc. And they offer different products for different people because everybody's goals, dreams, and desires are indeed different. Now, when you're talking about financial products, some of you may know all of this, some of you may not. There's this virtual alphabet soup that's involved of front-end loads, back-end loads, expenses, fees. If it's not a fee, is it an expense? So you have all this data thrown at you, and many times you're not getting clear advice. Then you get the folks that are insulting your intelligence with the commercials showing the guys over here. They're out on a boat and they're checking their portfolio from their laptop. Of course, they've got Wi-Fi right in the middle of the lake or wherever they're at. But it's interesting to see how everything is great and everybody's out on their yacht, and no, it doesn't work that way, because for every person that's saying the market's going to go up, there's another person saying the market's going to go down. There's a third group of people saying they don't know, and guess what? All three of them are right, because we have no idea. Now, we can read the tea leaves, we can figure out some signs, we can go on past what has happened in 87 and what happened in 2001, and we can look at some different types of economic data and figure out where we're going to go from here. But the point is, most people don't care about the economic data. They care about, do I have enough money to live? Do I have enough to retire? Do I have to work longer? Because people are working longer, and it's not because some of them want to, it's because some of them unfortunately have to. So remember when you were a kid and you loved roller coasters? I mean, everybody liked roller coasters, or most people did. And well, when you're 66 years old, you're not out on a roller coaster. Usually. But however, you don't do a lot of things now that you did when you were 18, 20 years old, because you are older and things have changed. So if you're 66 and you're on a roller coaster, God bless you. That's awesome. I just hope you're healthy enough to do it. But the point of this slide is to say, you got to act your age. You got to act the way you are supposed to. And that includes what you put your money in and how you invest. Now, if we look at history, I'm going to make this larger again. If we look at history from 1932 and up until this slide ends in 2000, and I think 16 is when that one ends. So there's these there's these different periods of time where the market has had a downturn, or it has tanked, or it has had a correction, or the myriad of different terms that are used by our industry, of more than 10% in one particular year. And you'll notice that these kind of cycles happen kind of like every 7 years, so to speak, and it is a normal recurring thing. So when the market is down, people seem to get, oh my gosh, what happened? And they act like this is something new. Well, folks, guess what? This stuff happens. So it's not a matter of when the market tanks or if the market tanks. It's the matter of, are you okay with what you have your funds invested in? Do you have the right amount of risk? I know that sounds kind of silly, the right amount of risk. Well, if you're young and you are not planning on using this money for 40 years, risk is no big deal. And that's where you hear, don't worry about it. It's a paper loss. It'll come back. Or you're in it for the long haul, and all of the myriad of things that people say. Well, if you're 65 and this happens and you're going to retire next month, well, that's an issue. So the older you get, the less risk you should take. Now, I can tell you that last year there were people that were saying, the market's on fire. Why would I not want to be in part of this? Why would I want to take anything off the table? Well, remember the old adage, buy low, sell high? Unfortunately, many people don't sell when it's high because they have this greed involved where they think it's going to go even higher. Yes, I said greed. And whether you realize it's greed or not, it's the innateness of our human being that says, I want more. Yes, it's doing good, but I'm not going to take it off. I want more. Well, buy low, sell high. There's a reason why we're taught that in our 8th grade economics classes. So what we challenge people to do is to say, okay, let's put together a map. In our case, we call a money access plan. Where are we going to put our money? How are we going to put our money? Well, how much risk are we going to have? That's a loaded question. What our firm does, which many firms I don't think do, but what makes us a little bit different is, once again, there's this triage, there's this conversation of goals, dreams, and desires that we have, where the first thing we're going to do is we're going to talk about what makes you tick. When am I going to retire? Maybe I already am retired and I'm just concerned about not running out of money. Maybe I'm not worried about running out of money. I'm worried about how am I going to transfer these assets to the next generation without paying a ton of taxes or triggering some other issues that are potential, like I can lose my assets if I need nursing care. There's a host of things that a really good financial advisor who's well versed in all of these areas can help you with. Now, I'm not a lawyer, I am not an accountant, I cannot give legal or tax advice, but I have associates who are. Therefore, I can plug them into the mix and we can have a virtual dream team, so to speak, of an accountant, an attorney, and a financial advisor all working on the same page to give you a plan that is going to give you the map to your destination. And it all starts what I refer to as the color of money. Now, I invite you all to go to our website, and on there you'll see a link that says color of money. And you'll get this little cartoon character that's going to ask you some questions, and taking this 10-minute little quiz, it's going to give you a score on what we call, what's your color of money? What's your risk tolerance? Score goes from 0 to 100. Now, there's no passing grade. Usually there's no passing grade. No, there's no passing grade. So let's say your score is a 50. Let's say that you're right dead in the middle. Well, you're not exactly a risk taker by extreme, but you're also not extremely conservative. You're right in the middle. So what does that mean? Well, the next thing we do is we say, well, we got to take your portfolio of what you currently have, and we got to run that through a little test to figure out what's the risk level of your portfolio. And if your portfolio is a 90, meaning it's very, very risky, and you're a 30, meaning your goal is you don't want a lot of risk, something is skewed. Well, when the market tanks, not if, when the market tanks, you're going to be upset. You're going to be frustrated. But if the market is at a 50 and, pardon me, this fell off. If the microphone fell off. If you're at a 50 and the market is at a 50, you're equally yoked. So, but in this scheme of things with the color of money, there's three different colors. You have green, yellow, and red. And green is simply your safe money, things like CDs, money market, and treasuries. Yellow is your bonds and your annuities, and red is your things that can be subject to risk, such as dividend paying stocks or other types of securities. Now, I'm not saying any of these are all good. I'm not saying any of these are all bad. I'm saying there's three different categories. They're used for three different things. So the next thing we do is we say, okay, let's talk about our goals. We're going to need some money that's going to be for our principal protection. We're going to need money that's going to be for our future income. And we're going to need money that's going to basically be our emergency fund and for growth. Now, what that basically does is it says each of those buckets have a different goal. Each of those buckets have a different time horizon. Each of those buckets have a different end result. So if I'm looking for long-term growth, well, I can have funds in a more risky investment. If I'm looking for income that's going to start next month, I need that secure. I need that somewhere where it's not going to be subject to a lot of market risk or inflation risk. And if I have a bucket of money that, if the roof blows off my house tomorrow and God forbid I need to come up with some cash, I can get my hands on it right away. Well, having those different buckets, having those different goals and dreams and desires mean you should have your money in different places, albeit you should have it in different categories of risk. So instead of having everything in one big bucket and you're just going to pull from it and then your whole portfolio goes up and goes down, well, if I have my safe money and safe investments, and if I have the money I'm willing to accept risk on in the red or in the risky buckets, that's fine. But what kind of risk? Well, there's a lot of risk. There's risk and there's volatility. Risk means, can I lose? Volatility means, how much will this swing? So there's conversations that you should have with the person who is your trusted advisor before they just stick a 4-color brochure in front of you and talk about returns for the past 15 years. Because do people even really know what they have? If I said, what are you invested in right now? Can you name the mutual funds? Can you name how much you're paying in fees? Can you name how much risk is involved? Most people can't. So that's what we do with what we call the 5 portfolio analysis report. And what that means is the first thing we're going to do is the asset inventory, where we're just going to have a conversation about what you have. We're going to ask you to bring in your most recent financial statements, the actual policies. If you have annuities and in life insurance, we're going to ask you to bring in your will and your most recent tax return. What we're basically saying is we're giving your entire financial picture an MRI, and we're going to find out if there's anything that is wrong. The next step will be what we call the Morningstar Report. We take the data that we have from your portfolio and we access this thing called a Morningstar Report. And Morningstar is kind of like a Consumer Reports kind of organization. All they're going to do is give you data, what's good, what's bad, by the metrics that they're showing you, because good and bad can be relative. How much risk do you have on a scale of 1 to 5? How much are you paying in fees? Do you have any assets that are overlapping? Do you have 9 mutual funds that are invested in the exact same thing? Stuff that many people don't realize that it's really good to know before we talk about what you should have your money invested in. The next thing then would be to what we call the investment analyzation, where we're going to then make a recommendation on how, if at all, your program can be improved upon. That's where the conversation comes in. Now, by that point, we probably have met at least 2 or 3 times. There's no time frame on this. There's no, we have to get this done. We have to get it done now. We're working on our own set schedule as far as how soon are we going to implement things. Some people there's urgency, other people there's not. we're not going anywhere. So it's not something that you have to do now. It's not a limited time offer that's going to, go away. So after we have all the data, we then proceed to what we call the income plan. And we're just basically going to give you kind of like a spreadsheet where we're going to list all of the different vehicles that you may have. And then we're going to talk about how much you have coming in Social Security. We're going to talk about what your goal is. I need $5,000 a month. Where am I going to pull that $5,000 from? I need to pull that from a place where it's going to not run out of money, but yet I also want to pay the least amount of taxes as possible. So this is where we actually show you where you should put it, why you should put it there, and how you should structure the money coming out, because it's easy to talk about growth. You could throw a dart at the Wall Street Journal and get lucky and talk about where you should invest. The true advisor is going to help you with which ones do I pull from? I can't give tax advice, but which ones have the most taxable issues when I pull the money out? Is there estate issues if I pull this out of here and give it to my kids? There's so many questions that people think financial advisors, all they do is say, here, invest in this, and then it goes up or goes down, and when you call them, they give you an excuse. The point is, a true financial advisor as a fiduciary truly cares about all aspects of your financial plan. We're going to talk about wills and whether you should have a trust, and if you do, we'll recommend an attorney if you don't have one. So there's many, many, many different things. But as I digress, we now come back to the plan and we say, okay, look, on the left-hand side of the screen, here is the red money that is in your portfolio. Here is the yellow money that is in your portfolio. And in this particular instance, a huge portion, way too much, is subject to market risk. The questions that this client had answered indicated that they were comfortable with a huge portion being yellow and a little over a third being in green. Now, because those numbers are different from what they have versus what they want, that shows us that there is an issue. There is something that needs to be changed, and we can then have dialogue on how those things can be changed. Now, products are the easy part in our line of work, because there's thousands of products, and we don't recommend the same thing to everybody. So we're then going to have a tailored approach with the help of the dream team that we had mentioned earlier, with some of the great minds that we have access to help structure what you have your money in. Some people think life insurance and annuities are not a good thing. Some people think they're awesome. And it depends on the person's need and desire. Some people think the stock market is incredible. Some people think the stock market is horrible. And I present to you that none of those are true. None of those things are awesome. None of those things are bad. It's how they are used in your particular portfolio. If everything you have is in one thing, I don't care how good it is, that's not good. You need to have your money allocated in a very, very responsible way, such as stocks, bonds, mutual funds, maybe real estate, gold, silver, fixed vehicles such as money markets and CDs. And not everybody should have every one of those, but many people have many of those. And the question is it allocated correctly? If you're 20 years old and everything's in a 2% CD, not good. If you're 80 years old and everything is in a high risk, very volatile stock portfolio, not very good. Somewhere in the middle there's good for both of those folks if they took the quiz, if they had the right metrics were shown to them saying, here's what you're saying you're comfortable with, here is a portfolio that matches that. So when the market tanks, you're not losing sleep, because that's the money that if that does go down, I have the luxury of time of waiting for that particular bucket to come back. I haven't lost the money that I need to pay the mortgage next month, or am I going back to work? Now, there's a couple of different products that we can offer, and this is not saying we're going to sell everybody products on this webinar, but I just want to show you a couple different things. First of all, this is what's called an equity indexed annuity, and the simple part of this is when the market is kind, your market earns a reasonable rate of return. When the market is not kind, your money is protected from market risk. So in this instance, let's pretend that this person put in $100,000 in 2000, and the red line indicates what the stock market would be, mainly the S&P 500. The green line indicates what's called the minimum guaranteed surrender value. So using those three metrics, this is an actual product with an actual company with actual returns, showing that in 2000, those three metrics in 2020, which basically would have been the first of the year in 2020, the green money in the S&P was obviously about 219. The annuity was 182, I believe. And the fixed bucket, or the guaranteed minimum surrender, is at 130. So what they're saying is, in the periods of time where the market has dipped, such as 2001 to 2002, and periods of 2007 into 2009, and then a couple little dips in the latter years, you'll notice that the red bucket's going down. The blue bucket is not going down. So what they're saying is, when the market is kind, you can earn a reasonable rate of return. When the market is not kind, your money is protected. Should you put all of your assets in this? Absolutely not. But for a portion of your safe money, for a portion of your IRA or 401k or your pension or money that you're going to need for a future income stream, it's kind of a neat idea to have some of that protected against market risk. Now, you'll have naysayers on both sides saying something is good, bad, or indifferent. If you have all of your money in it, it's bad. But if you have a portion into something as this vehicle, it's not a bad thing, because it's basically giving you some protection from market risk. Now, there is another little video that I want to share with you that talks about, for those that have the money in the market, what do we do? How do we have a hedge of protection, so to speak, on the funds that are in the market? And there's a way we can help people protect at least some, if not most, of the money that is in the actual market. So this is just one of the solutions that we utilize for our clients. Just take a look at this little video, because it explains it so well. It's just easier for us to play the video for you.
For as long as it's been studied, investors have not done well in the stock market, routinely receiving approximately half the broad financial market gains. The primary reason is investors, even financial advisors, have a hard time not letting their emotions control their investment decision-making. No one has actually come up with a solution to this problem. Until now. We put investors back in charge of their financial futures with WealthGuard. WealthGuard is a simple yet powerful technology that not only addresses the poor investing conundrums that have plagued investors for decades, it also communicates exactly what investors and their advisors need to know about your investments to make investing more fun and rewarding. Every day, WealthGuard watches all of your investment accounts, no matter if they're managed directly by an advisor, by you personally, or are still in a company retirement plan. It reports back the specific information to keep you confident as an investor, helping you to reach your financial goals. It works like this. Each investor chooses a unique WealthGuard percentage for their investments based on their risk tolerance. If you have multiple accounts, such as 401ks, Roth, IRAs, etc., you will receive a WealthGuard percentage for each account. The WealthGuard percentage is based on the balance of growth investments to income investments in your account. The more stocks in your portfolio, the higher the risk. The more bonds in your portfolio, the less risk. The WealthGuard percentage options rank from a low-risk portfolio at 7.5% to high risk at 20%. For our example, let's choose 10%. A moderate risk WealthGuard percentage. Our total account value is $100,000 in this example, making our WealthGuard value $90,000. As time passes, the WealthGuard value rises each time your accounts go up in value. So while markets are rising, your WealthGuard value rises and locks in after each new high. If there is a modest decline, you can confidently stay invested, as you always know the point you've predetermined as your maximum comfortable decline. If your account value declines by 75% of your WealthGuard number, a 7.5% decline if you have a 10% WealthGuard, A review alert is sent to both you and your advisor to confirm your ideal plan of action should your WealthGuard number be reached. Should the WealthGuard number be reached, 10% in our example, the predetermined action plan will be triggered. There are two options built into the wealth guarding process. You can exit the market altogether to a position of safety, or you can reduce the risk level on your portfolio by 2 levels. So, in our example of a moderate risk portfolio, the second WealthGuard option would move it from 60% growth and 40% income to 20% growth and 80% income. Our research shows utilizing option 2 and rebalancing your portfolio to a lower risk level would have historically been the smarter choice for investors. Whether you choose to exit the market entirely or rebalance your portfolio to a lower risk level, WealthGuard is there to help you achieve your desired outcome. Using WealthGuard, along with a sound investment plan, investors gain the clarity they need to invest for their retirement with confidence. By putting you in control of your investments, WealthGuard helps reduce the risk of a large market crash, changing your retirement lifestyle. Investing with added financial peace of mind can finally be realized with WealthGuard.
So you'll see basically via that video, we can then allow our clients to plug in to that solution, and whether they're assets that you're managing, whether they're assets we're managing, whether they're assets that are still in your 401k plan at work, we can show you a way to get data, and we can show you a way that you can protect against future loss. Because granted, you need money in somewhat of a there's some risk involved in the market. Let me put it that way, and that's imperative if you're going to expect growth. But how much risk? That's the key, and that's the main thing that we're about, is showing people the differences of that. Now, the next thing I want to talk about is, besides the actual where I put my money, well, what about all the other stuff? What about the Social Security? What about the actual pension plans you have? What about, you're expecting an inheritance? What about all the other facets of money? And that goes back into that chart that we showed. Well, what about Social Security? Should I take it now? Should I wait? Should I take it at 62? Should I take it at full retirement age? Yes. What if I wait till I'm 70? What if I die at 69? There's so many different things, and there's so many different calculations. This analysis shows you here that there's more than 20,000 different calculations, and that just boggled my mind. I actually had to research that and find out that it was actually true. But there are so many different things that have factors involved when I should take the money. Is it my second marriage? Do I have to take my ex-husband's? Anyway, we can help you with that. So that's probably the biggest question we get. How do I protect my assets from risk? When should I take Social Security? Are the two leading questions that we get, and that's the biggest part of what we do. Keeping it simple. I know we went through a lot of data, and I'm just trying to show you basically all we do for our clients to help them with a portfolio that actually makes sense, where everything's working in concert with each other. So, that being said, if you would like to have dialogue with us, we have a free 1-hour consultation, which obviously in this market that we're in, we cannot meet face to face. So we can do it on the phone, we could do it virtually, similar to what we're doing now. For some people, they like this solution called Skype, which is a way for us to actually talk and see each other. But anyway, the goal would be we would have some communication. We would talk about, as much as if we were sitting across the table from each other, talk about your dreams, goals, desires. And there's 2 resources. I mentioned people that sell books. Well, we give them away. I have 2 resources that normally we sell on our website, that for when people want to talk to us, we give them these 2 resources for free. It is not predicated on you talking to us. It is not predicated on you meeting with us. Simply shoot us an email at GFS Financial Advisors, and we will simply give you the book via a there's two different formats, and we can discuss that with our people, whether you have an e-reader or whether you just want a PDF, etc. But anyway, we can give you these two resources that I personally have written. They're not ghost written and I just slap my name on. I personally have written these two books, drawing on my vast years of experience in the financial industry, which started around 1987. So, that being said, if you have questions, concerns, we would love to be able to chat with you and assess if we can help. I have to show you this little disclosure, of course, which obviously will be on our website as well, which you can click, but it basically explains that this is not a goal for us to sell you products. It is, in a way, how we basically meet people to have a conversation to see if we can help them in the future. So we hope you've learned something. I apologize if I spoke fast and try to throw a lot of stuff out in a short period of time. My goal was to basically just say, look, we've been here a long time. We're not planning on going anywhere anytime soon. And if you want a second opinion on what you have from people that have the knowledge to give you that second opinion for free, we'd be willing to do that and see if we can help. So, till we see you soon, stay safe.